UK banks and finance firms will cut another 18,000 jobs in the first quarter of 2013, the biggest reduction since the start of 2009, as Europe struggles to emerge from the debt crisis and regulators impose tougher capital rules. Joining me on the line is Merina Willemse, economist at Efficient Group. Hello, Merina. Merina, do you think these financial job cuts are necessary?
Well, yes, costs need to be cut. This is the only real factor that banks can still control and use to alleviate the tension in their balance sheets. Most banks in the euro area have staff levels that were tailored to the demand estimates of 2008 and 2009, which did not materialize now 4 years later. So they'll have to make these cost cuts.
What impact do you think these job losses will have on the financial sector?
Well, a reduction in labour might reflect positively on the balance sheets of the banking sector in the short term. So this will be positive for the financial sector, the way it looks and feels in the short term. But in the medium term, the effect of large-scale unemployment could hurt the real economy. Household consumption expenditure will decline as demand falls, which could eventually lead to a drop in the overall output by manufacturers. And at the same time, imports and tax revenue would decline, and the economy would either shrink or expand at a very slow pace. Of course, the long-term outlook of such a consolidation process should mean that the economy returns to normal and that after everything has been absorbed by the market. So it is a very painful but very necessary process.
And what big issues do you think banks face now?
Well, I think that banks will most likely in the next few years continue to increase their cash revenues or the cash reserves due to the compulsory regulatory requirements that are upon them each year and increasing each year. And of course, they need to keep their cash reserves quite high to hedge against increasing risk. Banks will continue to deleverage to sort out their balance sheets by cutting costs like they're doing at the moment. Banks will probably be focusing on more incentives to increase customer deposits, and they'll probably be forced to reduce their loan-to-deposit ratio. Therefore, it means that credit to consumers and corporate lenders will probably remain very tight throughout 2013. In short, I think that the consolidation pressure will define a very cautious banking industry in the next 6 months, and business confidence will probably remain fairly muted.
Regulators are saying banks are too big for the current environment. Do you agree with this?
Well, in short, yes. Banks, and specifically investment banks, have thrived in the period before 2007, when the financial crisis bubble first burst, before it burst. This allowed them to employ and expand a lot of people, and they expanded at a very rapid pace. Now, in this very much more risky economic environment, costs are at an affordable high level, and adjustments have to be made. This means that to be able to comply with more and stricter regulations in the banking sector, current expenditure will undoubtedly need to be cut in order for these banks to survive. And this is why the current environment means that these banks need to shrink, probably proportionately to what they can actually just perform in output.
Thanks for joining me, Merina. That's all for now. Here at Dukascopy TV, we'll be keeping you up to date with the latest financial news throughout the trading week. For now, though, goodbye.